Live from Singapore, this is Insight with me, Haslinda Amin, where we dive deeper into the stories that matter with crucial context and sharp analysis. Coming up in the next hour, Asian equities climb while the dollar and treasury steady as investors assess comments from the Fed chair sowing doubt of a rate cut next month. China's latest activity data shows a jump in retail sales as big barrel stimulus begins to kick in. We'll get investment insights with KraneShares Xiaolin Chen. Also ahead, an exclusive with the Vice Chair of Reliance and India's Disney's joint venture. We'll ask how they plan to challenge the dominance of streaming giants, the likes of Netflix and Amazon Prime. Plus, the CEO of Vietnam's Techcombank is with us to talk about the hunt for foreign investment and how AI is changing the finance sector. The markets, we're keeping an eye on the Chinese market on the back of that activity data. Retail sales coming in better than expected, but output lagging behind. Still, on balance, it is a positive day for the CSI 300 index, just inching slightly higher by about 1/10 of 1%, giving up some of those earlier gains. Puts into question how much more stimulus can we expect from the Chinese government to prop up the economy. In terms of the Fed, we heard from Powell saying, you know what, maybe it is not in a hurry to cut rates further. The economy remains resilient, and that's having an impact on the dollar, currently down about 1/10 of 1% in terms of the dollar index. Quite a relief for some of the Asian currencies. The yen trading at 156.36. In terms of the stock futures, this is how it is looking. We know Treasury is pretty much steady after yields rose yesterday on the back of Powell's comment. Taking a look at where we are in terms of the S&P futures, currently down by 0.3 of 1%. So, some green shoots may finally be appearing in key parts of the Chinese economy with a continued focus on consumer demand and stimulating consumption. Let's bring in Xiaolin Chen, Head of International at Investment Managers, KraneShares, joining us from London. Xiaolin, good to have you with us. I mean, it's a pretty mixed bag when it comes to those activity data.
Yes, at least, some sign of relief and improving. Shall we say that? I agree. Industrial, output could be better, but also just 1 month after the announcements of the policy bazooka, shall we say, in September, now we start to see the most and the key important components of the data, which is the retail sales. It's reflecting consumer power, the actual resuming of that power, if we may say. All the policy announced in this round is really centered around helping on the demand side. And if the demand side could start to show a sign, this is still early days. But if you already seen some recoveries of the consumer that is more willing to spend, given they have benefited from the immediate cut of the mortgage rates, nearly benefited 50 million households with 150 billion RMB interest less paid by them. So this is already, I'd say, it's a very good starting a few steps to see that policy start to kick in effect. So obviously, this data includes the Golden Week, include the single state sales that just happened a few days ago. So it's a little bit of a combination of the policy and seasonality.
Consumption showing signs of recovery. The question is sustainability. Some people are suggesting that it can't improve further if you don't see further stimulus. Some even suggesting that we should be seeing another round of QE.
I guess, it's when September the policy bazooka happened, I think obviously the scale that it introduced in terms of the liquidity amount was quite surprise on the good side, that built up on consumers or investors' confidence or expectation to say, I need to see more. I give you a story, like my son, 5 years old, his birthday would get him 5 presents. He said, straight away he asked me if next year he will get 6 presents. Okay, that's the expectation. I think it's similar for investors today, that we want more, want to see more. But I have to say that the Chinese policymakers is doing the right thing. One, they're helping on the demand side. Second, they're being very transparent of the policy they're introducing. And third, they've been very communicative. These are all the lessons they learned from the past that they have been saying even at the end of the NPC to say, listen, this is the policy that's approved for now. There's more to come. I believe the more to come will be more decisively on which area these spends will be heavily focused on. And second, what more can we do on consumer side? And a lot of the policy introduced, we have yet to see the full effect. To give you an example, the trade-in program, we start to see kicking in effect, but we haven't really to see that fully roll out in the entire country. Obviously, President Xi Jinping and the whole Chinese policymaker has been repeatedly saying economic growth is our target, is on top of our agenda. I do believe this is the moment you get to believe what they put in. Particularly if you see from their announcements of policy in September and roll it out, it's really just a matter of a week. Those kind of efficiency, you don't see them anywhere else in the market.
The thing is, Xiaolin, the external environment is about to get even tougher with Trump 2.0. He's suggested he may impose as much as 60% tariffs, additional 60% tariffs. That will play out in the economy as well. That will impact investor sentiment, impact consumption as well. I mean, when investors expect more, they're right in doing so, aren't they?
That's a great question. We get asked a lot, since the election results are announced. I'd say one, tariff, you would agree with me, is double-edged sword. Today, there's no single way of saying we're only going to make this difficult for one side of the corporates than the other side. That's one. Second, I think anything that you announced or said during your campaign to the actual policy going to be implemented, there are always some discrepancy. So we got to wait and see the actual implementation of the policy on tariff that's introduced by America at the end of the day. And then third, I remain a bit optimistic. Mr. Trump is a business person in his whole background. I think that's actually good to China, because then we would know a path to work together, would understand how we could construct a deal or things we can talk back on the table to move on to an agreement. And people around him, even his biggest sponsor, Elon Musk, Tesla's revenue, 1/3 is actually from China. And I remember how we read all the progress that Tesla made with setting up a factory in China. Literally in Shanghai. Back then was Premier Li was in charge, and he literally helped the whole process from Tesla talking and setting all the factory up in a matter of months. I think Elon Musk has nothing but good experience interacting with China, doing business with China. I think these are the key person, shall we say, the music to the ears to Mr. Trump. I think if this is the case, I do actually stay optimistic that he would have more constructive, executable, and actually in a more constructive way to be done with interaction with China and any policy that America may introduce.
At the crux of this trade war is actually technology, chips in particular. You got to wonder how Chinese tech stocks will perform on the back of, such a challenging backdrop in U.S.-China relations. How do you expect them to do? And, taking into account the results we've seen so far?
Semiconductor or chip is obviously China entered the game 30 years later than the rest of the peers. So they've been trying to play the catch up very, very quick and as quick as they can. Obviously, they came in slightly to the value, lower side of the value chain by assembly. Now they move up to the ladder of the equipment, so on and so forth. Touching the IP, which is the core part, would be challenging for them. But I think in chip particularly, China is trying very hard on the, our research side, recruit the talents globally. They're focusing on probably slightly not the most advanced, but middle part. So they're sufficient for now. But this in a semiconductor is an area they must develop, period, the end. It's a matter of time when they catch up. It's not if they will catch up. In terms of Chinese technology company, they stay more broadly diversified with their line of business revenue. They don't stuck with one area. For instance, Alibaba is e-commerce, is iCloud, is logistic, is musical, is entertainment, it's all different areas of the areas that's supporting the whole business going forward. This is a interesting business model, only exists in China, benefits from them having 1.4 billion as the customer.
Xiaolin, thank you so much for staying up for us.
Pleasure.
3 a.m. in London. Xiaolin Chen, Head of International at KraneShares. Thank you for that. Now, still to come, Disney and Reliance Industries have completed an $8.5 billion mega deal to form India's largest media powerhouse. We'll speak exclusively with the Vice-Chairperson of the joint venture. That's coming up. Keep it here with us. This is Bloomberg. Welcome back. Walt Disney shares surge after fourth quarter results beat expectations. The entertainment giant also delivering a rare long-range forecast for earnings growth in the next 3 years. The results were driven in part by a second straight profit in its streaming business, a key part of Disney's future, as CFO Hugh Johnson told us earlier.
We feel optimistic about, as the industry is coming together, we're going to continue to both add subscribers, and in addition to that, because of the value we're delivering with the great IP and the great product that we're putting into this service, we'll be able to take pricing as well. And that combined with good cost management that we have in place in terms of good disciplines on that business, we feel very optimistic about where streaming is going for us.
And streaming is sure to play a big role in Disney's long-anticipated $8.5 billion media merger with India's Reliance. The newly inked tie-up creates an entertainment giant with more than 100 TV channels, control of key sports rights, including cricket, and a substantial subscription base. The new Disney Reliance Vice Chair, Uday Shankar, joins us now. Uday, good to have you with us, and congratulations on the deal. You know, in your words, it is a monster deal. I'm just wondering, how much will it change the game for you? How much will it influence the landscape for the industry?
Thank you, Haslinda. Good to be here. We are the industry, given how big the business is. On day one, we'll be reaching out to 750 million people in India. So the industry will be what we do, and that is why we are extremely focused on innovation all around, in content, in distribution, in consumer experience, and in monetization models. So I'm really hoping that now that we have the responsibility of guiding and shaping the media industry in this country for a number of years, we do a good job of it.
How do you reinvent? How do you make the markets bigger? I mean, that's a goal for you.
You make the market bigger by not looking at the market as one monolithic, homogeneous entity, because there are many Indias in India. And the television business that both Star, Disney built and Viacom built, it was built on the back of looking at India in its constituent parts and creating solutions, content and consumer solutions for each of those parts. And I think with digital technology, we have an opportunity to take that initiative much deeper. So when we are talking about 750 million people out of 1.4 billion people in this country, we are talking about creating content and consumer solutions for literally hundreds of cohorts. And that's something that's not been done. It's still very much in its first phase. When the big streaming companies look at this market, they have still targeted the top 100 million people, whereas India is way bigger than its top 100 million people.
Uday, are you clipped in any way? Because the deal was cleared by the regulator with some strings attached, with some restrictions. Will those restrictions impede you in maximizing the revenue potential, for instance?
Look, the regulator did what it felt in its wisdom was the right thing to do in order to protect fair market competitive values. I think there are some restrictions that have been placed, and those put serious discipline on how we operate. But they'll also force us to be more creative, more innovative, and come out with newer solutions.
Some of your competitors have said that perhaps, you know what, you may have a big market share, but in terms of, the ad sales, ad revenue that you'll get is just going to be marginally higher. How do you respond to that?
We will, if you look at status quo, then probably that argument can be made. But that's exactly the strategy or the philosophy behind this combination. We've come together not to just incrementally do the same things more or better. We have come together to review everything that's been done or done so far and disrupt that. And one key part of that is how you monetize. I think media companies in India and globally have been very lazy in innovating on monetization models. Even companies that have completely transformed or revolutionized consumer experience, distribution, etc., they still stick to the same format of selling a subscription and selling advertising of video ads. I think there is a lot of innovation in that. Technology today allows you to do that. Consumers are open or receptive to those new innovation models. And there are enough people who are willing to take their message to those consumers and who are willing to pay if you're willing to be innovative. And I think you will see a lot of focus in our company, in GeoStar, the new company that's been created, a lot of focus on innovations in the business models.
So how soon do you think you'll see the impact? How soon will you see the numbers? How soon will you see that increase in ad revenue, for instance? And what kind of numbers are you anticipating?
Shareholders are not very patient. So we are working on a very aggressive timeline. But I'm talking about some really serious interventions which require interventions in technology and in the business model, getting the market ready. So it will still take some time. But we have a very aggressive agenda and we are working overtime. And I think the upsides will be visible real soon. And when I talk about those upsides, I talk about upside on the streaming side as well as on the television side, because I'm not one of those who believe that television is already dead in India. I think there is a narrative that's been sort of imbibed by everyone that television is dead, and hence people have already stopped feeding television. Not so in this country. I think television still has strong legs, and it has a fair distance to run, and we'll continue to provide it with the nutrition to run.
You're confident about the streaming business. Talk to us about the potential. How are you going to go about doing it and building and ensuring that you have the growth that you want? What's the strategy? What's the model will you be adopting?
I can't be discussing the entire business model with you for two reasons. One, I don't want to, and two, it's still in evolution, to be honest. However, I have to tell you, look, Reliance has been at the forefront of whatever value Reliance has created, in my view, has created that with two very clear focuses. One is disrupting the status quo, and two is to create products and solutions that are available, interesting, and affordable for the broad masses of this country. And I think that's exactly been my journey in the past. I don't believe in creating solutions for the top tier of Indian society. The value in India comes from its 1.4 billion people. The irony is everybody talks about the 1.4 billion people, and when they start designing their strategy, they all look at the top 200 or 300 million people. We are very focused in this JV that we will take our services, especially our streaming products. Television is already distributed, right, but we will definitely take our streaming products to the lowest echelons of Indian society and make it, create offerings that are attractive and affordable to all of them. So we are looking at really taking a large slice of India.
So you're not looking at premium subscription model per se?
I'm not looking to limit ourselves to premium subscription models only.
Let's take a look about competition. You say you're so big, you're a monster, and there is no competition. Isn't there? I mean, what about Netflix? What about Amazon? I mean, that's fierce competition for you. How are you intending to perhaps, ease that stranglehold they have on the OTT market?
So first and foremost, we are not a monster. I don't see ourselves as monsters. If you reach out to 750 million people, you definitely have scale. But coming to your question, Haslinda, I think these are great companies. They're doing a great job, but they have a very different business model, and they are targeting a very different India. As I told you, we are not looking at a slice of India. We are looking at all parts of India. We truly want to create a service that, on the streaming side, we truly want to create a service that's an alternative to television. So as and when people want to look at screens beyond fixed television sets, we are always there. The connected TV revolution in India is growing every day. We want to be present everywhere, and we are already there on linear TV. So I think our business is very different, our focus is very different, and our ambitions are very different from all these companies that you talked about.
You talked about how it's early days yet. It's hard to say, but you have some growth plans. And considering the growth plans that you have, do you see additional investment in it? We know that Mukesh Ambani, for instance, has suggested a willingness to perhaps, part with an additional $1 billion.
I don't know what $1 billion you're talking about. The JV has been adequately capitalized right in the beginning. And I think we have enough resources to fund our ambitions. And we are hoping that we won't need more money. But I think the shareholders are very committed to see this venture through and invest whatever is required.
And as you talk about expansion, are you also looking at consolidation? Give us a sense of whether or not we can expect job losses. When you see mergers, you usually see some consolidation measures being implemented.
Look, it's unfortunate, but if there are two people for the same job, there is not enough space for everybody. So there may be some impact. But we have such an aggressive growth agenda that we think we'll be able to absorb most of the people, and we'll continue to hire as we go along. In fact, if anything, talent is a requirement that we struggle every day to meet, because we want to grow so much. And this is a business which is all about, which is built fundamentally in people's minds. And for that, you need great minds. So we think that we are already a talent magnet, and we think we will continue to hire at a very aggressive pace.
Right now, the merchant entity is a big player in pretty much the cricket streaming as well as broadcasting space. But I know right now it's costing quite a bit of money. How do you intend to reverse that model? How do you intend to address it? Because we know that in terms of what it's costing, it's about $1 billion a year. That's a high cost.
It's costing more than $1 billion a year, and that's very high cost. And that, you have 1.4 billion people who can't get enough of cricket in this country. And so we just need to find, I think the monetization of cricket is limited by the ideation in the advertising and distribution space. I think if we expand the reach of cricket even more, and I think if we open up the universe of potential advertisers who can have access to the cricket audiences, there is significant growth possible. But you are right, there are a lot of, there is a lot of stress on account of the cricket rights.
Right.
But luckily, those rights are for a short period. And
Uday, we have to leave it there. Uday Shankar, Vice Chair at Reliance-Disney JV. Thank you so much. Plenty more ahead. Keep it here with us. This is Bloomberg.
Thank you.
The economy is not sending any signals that we need to be in a hurry to lower rates. The strength we're currently seeing in the economy gives us the ability to approach our decisions carefully. Ultimately, the path of the policy rate will depend on how the incoming data and the economic outlook evolve.
And that was Fed Chair Jerome Powell speaking at an event with the Dallas Fed. And investors keeping a close eye on comments from Fed officials as they look ahead to a potential rate cut in December. Markets also watching the latest on global tech earnings, with China's key names reporting into next week as we also await results from, well, guess who? Nvidia. For more, let's bring in Bloomberg Intelligence Senior Analyst Catherine Lim and our very own Avril Hong. Let's start with you, Avril. Of course, people mulling what the Fed just said. I mean, possibly reassessing expectations for December.
Yeah, I think Powell has delivered that pushback to the markets on what we can potentially expect out of December. Are we going to see a cut or not? And he sounded really cautious. He has reason for this. It's being backed up by the data. You look at how PPI came in hot overnight. We saw jobless claims lowest since May. This doesn't look like an economy that needs to see a rush towards rate cuts. So the sense you get is that the Fed is going to go fast on cuts and then eventually go slow, because don't forget, there are some of these key uncertainties for next year. What are Trump's policies going to look like for inflation? And I think given this pushback that we got from Powell, you see how the short end treasuries are reacting. They're finally getting the memo that the long end as well as the dollar had gotten from earlier in the week already, as the short end treasury rally is reversed. Remember, this was against the backdrop of what we got from this US CPI print. They were really rushing to those expectations on the rate cut.
So in terms of expectations, 80% of that rate cut now down to 60%. Of course, investors are also looking at earnings, whether, the valuations are justified. And of course, the big one, Nvidia, it is a high bar.
It's a high bar, and as our colleague Kriti Gupta likes to say, it's a blessing and curse for being an A-star student, right? So whether or not it delivers on revenue, growth, or guidance, we have Bloomberg Intelligence talking about how they see it being able to exceed consensus, and because of how its Hopper lineup of chips have been seeing greater adoption. And remember, earlier in the year, there were also some of these uncertainties about delays in its Blackwell chips, and that looks to have been cleared up a fair bit. So looking on the upside for Nvidia, looking pretty positive. And then you look at what its hardware partners are saying. We have Hon Hai, we have Quanta. They're saying they expect an AI server boom. So, this just bodes well for the market, darling.
Of course, for China, it's also about those earnings, Kat. I mean, how high is that bar for the likes of Alibaba, for JD?
Well, for Alibaba, definitely, and that's what's coming out tonight, Haslinda. Singles Day is just over. They are so far one of the, I would say, e-commerce companies that's actually come out to say that they did have higher GMV. Interestingly, JD.com overnight, they kind of shy away from that topic itself. I mean, I hear all the orders up, users up, but I just was looking for that GMV number. It didn't quite come through. So again, tonight, let's see what Alibaba said. Haslinda, it's not about the historical results that these two companies will be reporting or have reported in the case of JD.com. It's really about the trajectory going forward. And again, let's recap. The stimulus only came in late September, so it's all about October onwards.
Well, we have the stimulus, but we also have tariffs coming, and we have a stock that's been surging like crazy. I mean, on balance, how does it look for Alibaba?
I know, which is why it's the big question mark. At 10 o'clock today, we saw the October China retail sales coming out, beat estimate. But what's new? It's a lengthier Singles Day promotion, lots more for people to actually spend on. And then you get so what's going to happen in November? We cannot be spending perpetually through the end of the year and into 2025. So I think that is where, we need to see more evidence about how the stimulus is really impacting sentiment beyond discounts, and things needs to proceed from there. I personally don't think we're going to see very strong evidence of that, in the near term. It's going to take a little bit of time, so we'll see.
And beyond Alibaba, it's also JD.com. Will it be telling the same story?
Well, JD.com, likewise, again, they've highlighted that, they've got more merchants, more brands on, which is all great. Don't forget PDD too, value for money. PDD, different set of story, but they still have that China business itself. So we'll see.
And also, Avril, Avril, you talk about XPeng, Xiaomi reporting as well. Their number is going to be front and center.
They are.
It's all about EVs, and that's been the focus.
Yeah, I mean, we've been seeing a really competitive landscape, right? Whether it's the tech giants or the EV players, and they're also dealing with tariffs from the EU, and then you throw in what we potentially can expect from US levies next year as well. So it's a challenging environment for Chinese EV players, and the expectation is pretty mixed. So for XPeng, I think there is a widening of losses that's expected, pressure on margins, but Xiaomi is expected to kind of go the other direction, and I think about 30% revenue growth is seen. It has managed to accelerate its EV deliveries, and then it also has other parts of the business that are helping it along, right? You look at Internet of Things, that's benefited from the demand for household appliances, China's trade-in subsidies, and I think that's going to help to offset the weakness that we're likely to see in its smartphone business as well.
And there is a wild card, and it comes in the form of Elon Musk.
Yeah.
I mean that could be a positive for EV makers in China, possibly.
Potentially. I mean, you look at the crosswinds of sorts, right? When you look at Elon Musk and how, we're hearing how those EV tax credits might be cut. Who knows what happens eventually, but you get the sense also that Tesla is one of those companies that would do a lot better compared to the other EV players in the US space, not just talking about China. Look at how it might fare better than the likes of Rivian. So the landscape might start shifting, and it'll be really interesting to watch.
Kat, in the end, for China, it is about consumption.
Yep.
With the tariffs, if the tariffs are imposed, it depends on whether 60% is going to be it. Consumption will be impacted, and this is key for the Chinese economy.
Right. So, the tariffs itself, what it's going to affect is the manufacturing industry for China. And we know of so many jobs, the employment that relies on this sector itself. So if that part of the business does slow down, it affects everything, in China. So that's the ripple effect that could actually come through. Big question mark as to, how the tariff is going to be staggered through 2025. It could be an overhang for the next year. So again, the big question mark to that.
Come on, look into the crystal ball. Tell us, for 2025, how do we position for these tech plays?
Well, I guess, e-commerce, the rivalry is intense out there, which is why you've actually seen stocks like Meituan, for instance, outperforming, because on a relative basis, it's more behaving like a staples, because everyone orders online. You still need to do your ride hailing, etc. And the competitive landscape is definitely less intense than e-commerce. So that's what has been holding up the stock, and it will be interesting to see at the end of this month, as the company comes through, how they are going into beyond China. There are still markets like Middle East. Remember, Meituan is actually heading there. We've got a couple of Chinese companies that are heading in that direction, so we'll see.
All right, before I let you go, Avril, Baidu.
Oh, Baidu. Yeah, Baidu is interesting.
Let's not forget Baidu.
Let's not forget Baidu. It had its world event this week, right? It's interesting because this was a really early investor in AI from a decade ago. But despite some initial success in its ErnieBot, we've seen how that's kind of been eclipsed by popularity of other chatbots like the ones from ByteDance. So the trouble, I think, with Baidu is really how it's going to be able to monetize its AI investments. And we saw how it launched the AI glasses earlier in the week. I think that is its attempt at trying to get people that don't want to pay for AI services to buy a product that kind of wraps in, its large language model, Ernie. So I think that is its solution. But as to how much adoption we can actually see, I think that's something that remains to be seen.
Of course, the response to Meta's Ray-Bans. Thank you. Catherine, Avril, good to have you with us. Up next, we'll get insights on Vietnamese lenders with the CEO of Techcombank and discuss how AI is changing the finance sector. Keep it here with us. This is Bloomberg.
The truth is that the United States export market is very important for China, but it is not going to crush China's economy.
Why is America's market wide open for you, and why don't you have China open for America? If not, that's not fair. And he's going to stand for America first. And I think that's a very smart place to be. And it's a new day. It's a new leader. And I think it will make the world safer, stronger, and a fair negotiations and trade for everybody in the world.
There are many issues we differ on with China. And I do join in differing on them. But if you don't talk to people, if you don't engage in a discussion about what's possible or how are you going to respond, if we just slap on a whole bunch more tariffs, life is going to get much more expensive for a whole bunch of folks who actually voted for Donald Trump.
Some of our guests this week sharing their insights on Donald Trump's promised tariffs. Well, the prospect of a Trump presidency in a more protectionist world is also looming large as leaders gather for the APEC summit in Peru. Chinese President Xi Jinping earlier visited the National Palace in Lima, saying he wants to push for an open Asia-Pac economy. Xi also set to hold talks tomorrow with outgoing U.S. President Joe Biden in the last of 3 in-person meetings between the pair. Now, Vietnamese President Vo Truong has warned the APEC CEO summit of the dangers of a world with higher tariffs. He said, quote, isolationist protectionism and trade wars lead only to recession, conflict and poverty. Exports account for about 85% of Vietnam's economy, and the U.S. is its largest market. Let's delve deeper with our guest. Jens Lottner is CEO of Techcombank, one of the largest joint stock banks in Vietnam. Good to have you with us.
Thanks
I think it's the first time that our paths have crossed. You know, just speaking of the implications of a Trump 2.0, how do you see that impacting Vietnam's economy, an economy poised to, you know, to see growth of about 7%?
Yeah. So I think it's a good question. And to be fair, and I think probably our own strategy team already is thinking a little bit about it, right? I think to a certain extent, tariffs for an open economy like Vietnam cannot be so helpful, right? And I think that's pretty clear. At the same point in time, I think we really need to see how the administration is really playing it out, right? So will it be isolated just for, let's say, the biggest surplus countries like Vietnam? In that case, probably it might be a little bit more impactful than if we're saying it's more universally and applied across a lot of different countries. And then I think there are also other considerations like security, like other areas where there's probably a question exactly, will it be also against Vietnam or is it more China? And the other ones will probably be let off a little bit easier. And then I think also we just heard it, I think there will be implications for inflation in the US, et cetera. So again, I think in the last Trump 1.0, actually Vietnam still grew quite considerably. So we'll see actually what's really happening.
But that's the thing, right? Vietnam has benefited from China +1, but it is also on the verge, perhaps, of getting tariffs slapped on it. The sweeping tariffs that Trump mentioned. On balance, is it positive or more negative for the country?
So again, I think that's what I'm saying. If it would be generally across a lot of different countries, then again, I think from a relative position, nothing would have changed, right? And I think, of course, something would probably be going back to the US. On the other hand, there are still a lot of products which are produced in Vietnam, which might not be so easily brought back to the US. So in that case, I think it will translate probably to higher prices. That might translate to higher inflation, et cetera, et cetera. So, again, I think we actually need to really see how this is playing out, right? And in any case, I think, probably right now, the government is preparing to really understand what exactly will we do. But as I said, I think there are quite a couple of people in the country who still think that it might actually still not derail the economy too much. We still can continue on the 6 to 7% growth path.
How are you as a company reassessing this? Are you re-strategizing, re-looking at priorities, growth areas? How are you looking at the possible risks from a Trump 2.0?
So for us as a company, we're actually very much also looking into the domestic economy. So we're not so much on kind of financing the manufacturing sector, et cetera. And so still, probably in, I don't know, by 2030, probably Vietnam in itself will be one of the 10th largest consumer markets in the world, right? And of course, a lot of this is definitely supported by exports, and still, even in its own right, there's a lot of growth happening in the country. So, as long as we're banking that emerging middle class, and that's where a lot of our business actually, and we see still tremendous growth opportunities, still tremendous under-penetration, etc. So I think we're focusing very much on that. I think we are more looking like are there some implications on the overall GDP growth? Because we cannot run away from the overall economy. Banks are proxies on the economy. So from that perspective, we are clearly seeing, if we're suddenly seeing a 5% scenario instead of 7% scenario, what would that mean to NPL ratios and all of that? But again, I think none of these scenarios are really stress scenarios, right? They are still well within and what we can actually manage.
We know that you're a highly, highly profitable company, envious position. You don't need to capitalize any more than necessary, but you're also looking for a strategic partner. Talk to us about what you're looking for. How much of that stake are you willing to perhaps dispense of?
Sure. So you're absolutely right. I think we're always looking actually at partners because we're still a small bank. There are a lot of things we cannot do on our own, right? So, and I think in the past, rightfully, as you said, we looked for capital. Probably right now, capital is not so much what we're looking for, right? So we're looking for more for capabilities, especially when it comes to technology. And we're looking for probably access to certain trade corridors, right? So there's a lot of money coming in from Singapore, Japan, and Korea. So are there potentially companies who can help us to actually get into these trade corridors, bank in these trade flows? And ultimately, there's anyway an overarching limit of foreign ownership, which is around 30%. I think if right now people would be looking for, I think it might be 10, 15%, and that's usually what people are looking for in order to have a meaningful interest and also to be able to consolidate it in their balance sheet. So, and 15% is probably something we could actually come up with.
Of course, you can go as high as 30% as far as I understand
for
it.
a foreign investor, yeah,
yes.
that's right.
Might you consider that?
So, you see, I think we don't control these shares, right? So they are, I mean, right now we have around 22% foreign shareholding. So they would all need to sell, they would need to do, and basically saying, okay, let's really get out of this, which I'm not quite sure will actually happen because a lot of them, as you said, are very happy with where we are, right? So I think there's no secret in the fact that one of our major shareholders who owns around 8 to 9% is actually willing to go out. So 15% probably is a reasonable first step. And I don't think that at this point in time, anything going to 30% actually is even manageable.
It could be one strategic partner. It could be more than one. Are you exploring?
So it can also be that depending on the businesses, right? Again, I mean, if it's really one strategic partner, usually they want to have a big share, but there could be also smaller ones where we're just basically working with them, but on different topics, on different fields. And I think we already have strategic partners, not maybe at a shareholding level, right? But even our bank assurance partner, and these are all very important partners for us.
And the insurance partner, could you shed some light on that? You're looking for one. Where are you with that? Who are you in conversations with, for instance?
So, so we had indeed shared that, and we had a very good partnership with Manulife, and we went or decided to go some separate ways. And I think right now we are reaching out to other interested parties. And to be fair, it's very, very early on in the process. So there's no really concrete discussions right now going on. I think we also need to explore, are we going into a really just distribution partnership? Would we think about potentially setting up an insurance company? And then depending on if we're setting it up or not, I think other partners could potentially be of interest. So I think we're actually a little bit in the midst of these explorations, and nothing has really been put concretely down. But I'm pretty sure over the next 6 months or so, we will actually be having much more clarity.
Speaking of clarity, how much clarity is there in 2025 and the years beyond? And where do you see, growth really coming from?
So again, I think, as I said, we're banking pretty much on the middle class. So where we are actually really going in on the, let's say, corporate side is anything what has to do with real estate, cars, travel and entertainment, fast-moving consumer good, everything what is actually driven mostly by domestic demand, right? At the same point in time, you see a lot of under-penetration in a lot of kind of financial products, so wealth products, insurance products, and mortgages, all of that is very, very underpenetrated. By 2034, so in 10 years, probably Vietnam will be at the level of GDP per capita like China. So there will just be this enormous growth, right? And in a lot of areas, maybe our market share right now is only 5%, right? So I think just banking this booming economy, right? And maybe it's not 7%, maybe it's 6%, maybe it's 8%. I think that should give us a lot of runway over the next couple of years, probably decade.
Jens, we know that AI is changing the landscape.
Yeah.
In fact, how businesses run within the banking sector. I mean, how are you looking at it? What kind of investments are you making? And what can be expected in the coming year?
So we did, over the last 4 years, massive investments in our technology stack. And so the overall investments over the last 5 years were around $500 million. And we invested especially in data because of all what you just said, right? So our data stack is probably one of the most advanced for any bank in this part of the world. So right now we're actually using Gen AI already. So we're using it in order to drive productivity, but we're also right now trying to see, can we use it more to drive actually revenues, right? And giving much better information to our relationship managers, reaching out to our customers through chatbots, etc. So again, I think we are seeing in the cases where we're deploying it, improvements 20–25% on productivity, right? So over the last 4 years, we've grown our customer base we probably doubled our customer base, but our numbers of employees actually stayed the same. So we use Gen AI to actually continue that trend to be able to actually serve much more customers at a much higher efficiency level.
Do you need more manpower? I mean,
I think we need very different manpower, right? So if I think about...
So hiring is in place?
So hiring is in place. We actually do roadshows. We go to Silicon Valley, we go to Singapore, we go to Sydney, we go to London to bring also an overseas Vietnamese back because we need certain talents which at this point in time are not available in Vietnam. But we're also shifting the sales force very much, right? So we basically quadrupled the numbers of data people, tech people. And at the same point in time, we reduced the number in back office operations by 40 or 50%. So, and there's a constant hiring, retraining going on in order to actually make our workforce fit for the future.
Okay, Jens, thank you for stopping by. I appreciate the insights today.
No, it was
Jens
pleasure.
Lottner, CEO at Techcombank. Now, before we go, let's take a look at how U.S. futures are shaping up. Of course, this on the back of Powell suggesting that perhaps he is not in a hurry to cut rates further. We know that markets pricing in a 60% chance of a rate cut in December, down from 80%. U.S. futures lower, extending the decline, which we saw just yesterday, down by 0.3%. In terms of yields, two-year yields, of course, the most susceptible to policy, currently at 4.34, and in terms of 10-year yield, currently at 4.45. And in terms of the dollar, we know that the dollar is pretty steady. Some relief for Asian currencies in particular. I think we've been tracking the yen at this point in time. Now, before we go, here's a look at the guests joining Insight next week. We'll discuss the state of the global hospitality sector with Minor International Chairman Bill Heineke. Indosat CEO Vikram Sinha will also be joining us about opportunities in Indonesia's telecom sector. Keep it here with us. This is Bloomberg.